Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. March CPI report just came out, lowest level since April of last year, continues to move lower. Let's talk about implications of that for the Fed. Number two, jobs in March, in many ways still very strong. Unemployment rate very low. But one stat that is starting to show some cracks in the foundation of the labor market. And finally, S&P 500 up just a little bit above 7% year to date. Let's talk about that participation has not been very strong, especially during the last 2 months of the quarter. So CPI in March came out at 5% year over year. You have to go all the way back to April of last year to see an inflation figure that low. Let's remember, inflation peaked at 9.1% in June of last year. So inflation is moving lower. Also encouraging are the rent price increases. That has been a primary driver of high inflation as of late. So some slowing there. But what does this mean for the Fed? At 5% Fed funds rate and 5% year-over-year inflation for CPI. If we look back, all these dates on the chart here, these are the peaks of the Fed funds rate cycles historically after rising rates cycle by the Fed. Takeaway here, the Fed has never cut rates with CPI above the Fed funds rate. We have talked about that in previous quarters. It's starting to get to that point. If CPI continues to move lower, that the Fed will be in a position to repeat history. And it looks like this rate cycle does repeat or will repeat history with the fact that the Fed will ultimately cut before inflation gets well below the Fed funds rate here during the second half of this year. Now, labor market came out in the month of March, 3.5% unemployment rate. One of the positives, we actually saw the labor market participation rate inch up north of 60%. That's very positive. That's been very, very lackluster. Supply has been very lackluster during the past couple of years, especially post-pandemic. But one concern here is the number of job openings. This increased to a historic high. Companies have had a tough time filling positions over the past year and a half after the pandemic in 2020. But we saw this figure drop below 10 million for the first time in nearly 2 years. So if you're looking for the jobs market to weaken, the Fed came out this week and talked about a mild recession, anticipates a 1% increase in the unemployment rate. You're going to see the job openings drop and drop significantly before you see that spike up. So this is a data point that we're continuing to monitor very closely. And finally, participation in the rally. S&P 500 for the year up north of 7%. The last 2 months of the quarter, February and March, S&P 500 was up 2.7%. Those are large cap US equities. Take a look at the mid cap and small cap segment of the US equity market. S&P 400 mid cap index down 4%, small caps down nearly 6% during that 2-month period. Part of this were small and regional banks getting hit hard during that bank closure banking crisis in mid-March. And we've just seen large cap growth attract interest as Fed expectations have moved lower, and more investors are expecting the Fed to have to cut interest rates during the second half of the year due to the expected economic weakness during the second part of this year. We don't have to look very far to see how extreme this demand is for that large cap growth segment. If you look at that year-to-date gain, on this chart here, we have the market cap value all the way on the left of the S&P 500 at the start of the year, and we have the market cap for the S&P 500 at the end of the quarter, right? Just north of that 7% gain. 10% of the stocks in the S&P 500 are responsible for 90% of the gain within the S&P 500 during the first quarter of 2023. These names are familiar: Apple, Microsoft, Meta, right? These are the large cap growth names. Expectations, because of the impending expected economic weakness, are that the Fed's going to have to do multiple rate cuts during the latter part of 2023 in response to that economic weakness. And you're seeing capital flow into these large cap growth names. Remember, growth names typically do better in lower interest rate environments because they have future cash flows that are priced in at that lower discount rate. So finally, before we wrap it up, several different world records, interesting records that I came across this week. Number one, in China, a young 10-year-old broke a new Guinness World Record for juggling a soccer ball 8,147 times in 1 hour. Very impressive. But then I have to go over here to a gentleman in Australia that did 3,182 push-ups in an hour. I think that might be more impressive. That is incredible. But the gold medal, at least in my eyes, goes to a German man who was able to drink a Capri Sun pouch in just north of 10 seconds. In fact, 10.41 seconds. That is truly impressive by that gentleman. I'm not sure how long he was practicing, but anyways, for all of those, congratulations. Those are all pretty historic feats. With that, I want to thank everyone for watching, and I'll see you next time.